All right, from your homework, somebody had a question on question 9 in Cengage. It's number 20 for exercises in chapter 8. This is on acquisition costs and depreciation. So on January 1st, Jones Company acquired a new delivery truck for $40,000 cash. Additional cash payments during the year were as followed. They had taxes, they put a GPS system, they had insurance. So the first question would be, or the first requirement is to prepare the journal entries that Jones would make regarding the delivery truck. Okay, so again, this is exercise 820. So to prepare the journal entries, you're going to start with the purchase price. Of $40,000. You're going to include the taxes and fees of $3,200, and you're also going to include the logo and the GPS system because you're adding that value to the truck. It's included in the value of the truck that you're going to use. So logo and GPS. So that's $3,000. So the amount that you're going to capitalize, this is what we call it, capitalization versus expense, is $46,200. So the entry that you're going to make is a debit to the truck, which is your asset, and a credit to cash. It doesn't tell us it was on account. Actually, they tell us they paid cash. So $46,200. And don't forget about your dates. This was January 1st. Then the insurance is another entry. So the insurance is actually going to be an expense. Insurance expense for the $1,500 because that was just the premium paid for the insurance. They're going to use that. It's not a capital asset. And then we're going to credit the cash for $1,500. So those are your entries. Then in B, they're saying assume the truck had an estimated useful life of 5 years. So remember when you're solving for these, you have to know the purchase price or purchase price, and I'll say what was capitalized. So we know that was the full $46,200. So you need to know that. You need to know the useful life. Again, this is how long they think they're going to have that asset for, and that is 5 years. You need to know the salvage value, how much they're going to be able to get at the end of the life, like to sell it to a scrapyard or something like that. I think they're going to get $2,000. Okay. So they want you to calculate the depreciation expense on the delivery truck for the current year, assuming Jones uses the double declining approach. So we know using straight line, you have to first, when you're doing double declining, first figure out the straight line rate. So it's 5 years. So it's the one. It's one doesn't represent the years. It's just like 100 times the 5 to get to 20%, right? So each year under straight line, they're going to depreciate it by 20%. Now, under double declining, DD, we're going to take that rate and multiply it by 2. It's double declining, so it's doubling. So we get 40%. Then we're going to apply that rate to that the net book value. So in this case, we are going to look right at this $46,200 because nothing else has been depreciated. Don't forget, we don't include salvage value when you do this double declining. So you're going to take the full 46,200 times the 40% rate, what should get you to 18,840. And then the following year when you do it, so this would be year one. I know it's not asking you for year two, but if you did year two, you're going to take the 46,200 minus the 18,840 times the 40%. Okay? And then in C it says show how Jones would report this truck on the current year balance sheet. So you're going to take, so for C, you're going to take that original balance here, the 46,200, and subtract, this is the accumulated depreciation, and that would be your net book value. So you're going to take the 46,200 minus the 18,840, and you should get 27,720, I think. Hopefully that works out right. And we'd call that, it's an asset. We'd say equipment net. Okay, so that's the double declining balance.